We tend to believe, if anything, that big caps are more undervalued than small. And I'd almost look at it and think, if BHP broke itself up into South 32, 3, 4, 5, 6 and 7, do you reckon they'd go up or down? And I reckon, like South 32, there's more appetite for the smaller things and the conglomerates and things like that. I guarantee that for the most part, if you broke them up and turned them into smaller companies, most of them would go up. Yep. Mm-hmm. And that, I think, is symptomatic of saying a lot of passive money's driven into the big end of town. A lot of people are indexing that end of the market. More and more people are shifting down to the smaller end to find their risk. Generally, that means, if you like, the opportunities in a lot of senses are going to be left behind in the bigger end.
And what about the famous bond proxies with the bond market the way it is in the equity market, being property trusts, infrastructure, to a lesser extent healthcare, those things? Do you worry about them?
I think it goes a little bit to what Steve was talking about before. The danger really is they're all correlated in that they're going to get moved by the same thing. And the difficulty there is that lack of diversification, if you'd had it for the last 20 years, would have worked massively in your favour. As bond rates have come down, down and down and down, the question is, they're so close to zero now that, to me, the tailwinds have largely gone. And that, therefore, we'd look at it and think there is absolutely no way they can replicate their past returns. And on balance, we'd say there are better opportunities elsewhere.
Just on the resources, which we've talked about a bit earlier, early in, still think it's value there?
Yeah, for the most part, we still think that's probably where the best value is in the market, and why we've had a whole lot of cycles. So people know there's a cycle and there's nothing, if you look at the financial cycle, we've been increasing debt and increasing financial leverage and so on for 25, 30 years now. These are very long cycles. Resources underneath that are going up and down all the time, and we had a bubble in 2007 and then it blew off and we had the reverse side of it. In terms of where we are, price to books, all of those measures would tell you there's no way these things are expensive versus history. You're still buying the best quality resource companies at 1.5, 2 times book value versus history. There is no way that's super expensive.